Intel's stock price is down 14% in the last month. The company was already off to a rough start in 2024, and then its earnings announcement that disappointed Wall Street investors sent the stock price down even more. So is this a buying opportunity for those interested in Intel stock? That's what I'm going to answer in this video, looking at the company's longer-term history, not just the latest quarter, to answer if I think Intel stock is a buy on this dip. So let's jump in. Let's take a look at this company.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
All right, so like I mentioned in the last month, the stock is down 13.67%, and the bigger fall coming after the company announced earnings. Longer term, Intel has been struggling in recent years. Revenue was jumping higher until 2022, almost reaching 80 billion before falling down closer to 54 billion in the most recent trailing 12 months. Intel Corporation, of course, benefited when people were staying at home, buying more computers for the household. Remember, prior to the pandemic, it was likely that most households had one computer per household. Some may have had more, but having one computer in the house was typical before the outbreak. During the pandemic, however, one computer per household was no longer enough. People were learning from home, working from home, entertaining at home, and you needed one computer for each individual in the house, not just one computer for everyone in the house. So that created a surge in demand for computers, and Intel's revenue jumped from around 70 billion up closer to 80 billion as a result of that surge in demand for personal computers. Well, when the economy reopened and everyone that wanted a computer bought one, that created a gap in demand for personal computers, and revenue started falling because a lot of people already had computers. So revenue fell from around 80 to 50 billion dollars. Now we're starting to see a rebound in the personal computing industry. According to another company I follow, Advanced Micro Devices, AMD, their management said that they expect the personal computing industry to grow in 2024 after 2 years of decline. That's because the people that bought computers in 2020 and 2021 are going to start replacing some of those computers they bought. They're going to start upgrading or replacing those computers. The average replacement cycle, according to Intel, is 4 to 6 years. So we're going to start to see those computers that were purchased in 2020 start to be replaced, along with the new customers that are coming into the market. And so that combination is going to create growth in the personal computing industry, and that's going to be good news for Intel Corporation. Before this revenue declined, Intel was doing a good job expanding its operating profit margin north of 24%. That's an excellent profit margin, operating profit margin for any company, especially one in a mature industry like Intel, one that has strong hardware component sales, not so much dominated by software components. And so Intel's profit margin, it's demonstrated it can operate a significantly profitable business when its revenue is back in normalcy. It's not in wild fluctuation like it was in the most recent trailing 12 months. More importantly, let's look at cash flow from operations. Cash flow from operations is one of the most vital metrics I consider when making an investment decision. If any financial shenanigans are happening, looking at this metric can help uncover the fraud. Moreover, looking at profitability without considering cash flow from operations can lead to a misleading picture of a company's performance. For instance, look at the example I have created here. The company reported a net loss of $250. However, when you look at the cash flow from operations, it was a gain of $35. How can that be? Well, two expenses a company must report on the income statement are depreciation and stock-based compensation. Importantly, these are non-cash expenses. Money is not leaving the company for these expenses. In the case of depreciation, when a company buys a machine for $750, it pays all of that price up front. However, generally accepted accounting principles require that the company take the expense over a period the machine is expected to operate. So if the machine is expected to last for 10 years, The annual expense will be $75 per year for 10 years, even though the company paid the $750 cash at the time of the purchase. Also, when a company offers its employees a stock option, it's not parting with cash. However, it must record the cash value of the option as an expense on the income statement. So moving on to the working capital items, inventory management is the easiest way a company can increase cash flow. The simplest case is when a business has 100 inventory units, sells 30 units, and doesn't replace those units. The decision would reduce total inventory and increase cash flow. As you might already be thinking, this isn't sustainable. Eventually, the company will deplete all its inventory and go out of business. Accounts payable is the money that a company owes another company and has not paid yet. And accounts receivable is the opposite. A company can increase its cash flow by collecting payments faster and paying suppliers slower. If done with skill, companies at scale can take advantage of these timing differences to boost cash flow by a couple of % annually. Costco is one example that employs this strategy masterfully. Overall, if you observe cash flow increasing unsustainably, you should expect a reversal of that trend. The other big risk to consider is if you see a company reporting substantial profits but negative or weak cash flow due to rising accounts receivable. Moreover, so now that you understand the importance of cash flow from operations, you can see Intel, before the revenue decline during the peak stages, north of 40% cash flow from operations to sales, a very strong margin. Recently, even still at 21%, despite the significant decrease in revenue, it was able to maintain a cash flow from operations of 21%. Finally, let's look at what Wall Street expects from Intel over the next couple of years. For 2024, Wall Street expects Intel to deliver 6.8% revenue growth and earnings per share to rise by 35.7%. For 2025, Wall Street expects 11% revenue growth for Intel with 60% growth in earnings per share. And in 2026, 9.5% revenue growth with 29% earnings per share growth. So excellent prospects for Intel according to Wall Street analysts that are following Intel stock. They think Intel has excellent prospects to recover over the next 2 to 3 years, to recover some of those losses that it absorbed in 2023 and mid-2022. So prospects are looking strong for Intel to be sure. So following this sell-off, Intel is trading at a forward price to earnings of 18.7. This is the cheapest you've been able to buy this stock going all the way back to January 2021. You can see the valuation here, price to earnings, 18.7. At no point during the last 3.5 years were you able to find a valuation cheaper than the current forward PE of 18.7. So given everything we know about Intel, given its history, given its ability to generate strong profitability, cash flow at normal levels of revenue, and given that Wall Street expects and forecasts Intel to deliver near double-digit revenue growth over the next 2 to 3 years and very strong earnings per share growth over that same period of time, I would say if you're interested in buying Intel stock on this dip, I think it's a good opportunity. I think Intel stock is a buy on this dip here. If you liked the video you just saw and you want to see more just like it, please subscribe to the channel. I can't keep this channel free without the support of viewers like you. And if you're already subscribed, thank you, and I appreciate your support.